Assalamu alaikum friends. In this video we shall see in sequence of current liabilities some of the reporting issues in current liabilities, especially what is known as the contingent liabilities or provisions and provisions. So there may be some liabilities for which the timing or the amount or both is not confirmed. So in such a case, when the timing or amount or both is not confirmed, we need to have some in-depth analysis to fix whether these liabilities are required to be reported, required to be disclosed, or required to be ignored, right? So there are three possibilities. So for example, there may be some liabilities for which the amount is determined, but the timing is not determined, and even the amount is not certain. For example, if there is a lawsuit running in the court, and depending on the outcome of the lawsuit, if we lose the case, we will have to pay certain debt, for example certain tax. But if we win the case, we don't have to pay any debt or any tax. So in that case, this is a liability, right? So it is a present obligation, it is a liability, but it's a sort of a liability which depends upon a future uncertain event. That's the outcome of the case. So in that case, um, we need to go in depth and decide whether to go for the reporting or the disclosure or the ignorance, right? So we shall discuss these one by one. So in case of product warranty, at the time of sale of product, we actually undertake that if there is a defect in the product or if the product doesn't function, we will replace the product or replace some of the parts or make it serve it for free or things like that. It means that we assume a liability, a potential liability at the time of selling of the products, right? But the outcome, whether this liability is there or not, will be confirmed by whether the product actually gets dysfunctional or something like this. So again, that's a case of a liability with uncertain amount or certain timings, right? So now, what to do with these kind of liabilities? So accounting standards say that you have, first of all, you have to make sure that it meets whether the liability is a probable liability. It means the probability of being there is more than 50%, right? So how do we establish if a liability is supposed to be, it's a probable liability and there is a more than 50% probability that the liability will be there? So it can be based on the expert's opinion. For example, in the case of the lawsuit, the lawyer may be asked to ascertain, to document, to certify or to witness how much is going to be the amount of the liability and whether the liability will be there or not, right? So it can be based on expert opinion. Sometimes it can be based on the past history. So in the case of product warranties, maybe our past history may suggest that out of every 10 products that we sell, two usually come for replacement. So it means there is a probability of at least two of the products or 20% of the products coming back to us for repairs or replacement. So in either case, when the probability is more than 50%, then accounting standards say record it. And that recording means you debit some expense and you credit the liability, right? So in the case of product warranties, you say warranty expense debit and warranty liability credit. In the case of lawsuit, you say tax expense credit and potential tax payable credit, right? But usually we don't use the word payable in the liability side. We use the word provision because this is a liability of uncertain amount or timing. So the specific word for accounting for this kind of liability is a provision. So you say provision for taxation, right? So this is as a provision for the loss of lawsuit or lawsuit, provision for warranty liability, things like that. So in order to record a provision, we need to accrue an expense, as just we discuss again over here. You see, as we discussed. So companies accrue an expense and related liability means expense debit, liability credit for a provision only if the following three conditions are met, right? So provision are recorded only if a company has a present obligation as a result of a past event, right? So this is more or less the definition of the liability in the financial reporting standards. So it means it should be a present obligation, right? It should relate to whatever we have done in past. It should not be a purely future liability. So maybe next year I will have to pay a certain amount for the next year sales, this is not current liability today. This is not a provision today, right? Because it doesn't relate to my activities which have been done so far in the previous period, right? So this should relate to the work, the business that I have done so far in the previous periods. It means it should exist at current point in time as an obligation, number one. The condition number two, it is probable that an outflow of resources will be required to settle the obligation. It means the probability is there more than 50% that we will have to pay it. We will have to settle it. And the third is that a reliable estimate can be made of the amount of the obligation. So actually the amount can also be calculated, right? So there can be some situation when you exactly don't know how much will the amount be. So in that case, actually you cannot record a simple straightforward provision. And if we do not record the provision, then what do? If it is a reasonably possible liability, right? In that case, it means that the liability is something around 50%, maybe less than 50%, or maybe more than 50%, but something around 50%, or even if more than 50%, but the amount is not determined. In that case, we disclose it. We do not report it. Reporting means we record in debits and credits, and then we reflect it in the statement of financial position. But when we just reasonably possible liabilities, these are, we just disclose it. By disclosure we mean in the notes to the financial statements, in the narratives, we actually disclose that this is the case running in the court, and we are hopeful that we will win the case, but if we lose the case, this is the amount of liability which we will have to pay, right? So it will not be reflected in the statement of financial position, balance sheet, but it will be there in the disclosures. And the third kind of liability, which is neither, which is actually neither probable nor reasonably possible. So it's very remote chances of being there, very rare chances of being there, right? So a very nullified sort of case which is being run in the court, and we are sure that we will win the case. In that case, we don't even need to report or even disclose. But usually the cases are, if the law cases are there, they are disclosed, even not even if they are remote, they are disclosed. But for other remote liabilities, right, they are not even required to be disclosed in the financial statements. So for the provisions, here's an example of the product warranties. So this is an example, right? So 10,000 washers have been sold for 600 each. So there is a sale which we would have recorded. We are not recording sale at this in this presentation. We already know how to record the sale. So the selling price includes a 1-year warranty on parts, and the company expects that 500 units, that's a 5% will be defective, right? So 5% of 10,500 units will be defective, and the warranty repair cost will average $80 per unit. So 500 into $80 comes out to be 40,000. So this is the amount of liability which we will record towards the end of the year, right? So remember, contingent liability or provisions. So provisions, when we record them, they are recorded as adjusting entries towards the end of the period for the entire sale of the year. But before the end of the period, of course, during the year also, in the year 2020, when we have sold them, some of the mobile sets, some of the products, washers will come back for repairs, right? So in this particular case, the company honors warranty contracts on 300 units. So 300 units come back by a total cost of 24,000. So this is something that we paid. So this is not the provision entry. This is the actual accounting entry. We paid for it, right? So warranty expense debit and repair parts. So we replace the parts. So we credit the repair parts, right? So this is not a provision. This is the actual that we paid. But towards the end of the year, we know that during the year we have sold 10,000 units. So 10,000 multiplied by 500, the total amount is supposed to be 10,000 units multiplied by 5%, 500 multiplied by 80, so 40,000. Out of 40,000, based on our past experience, we have already honored 24,000. We have already repaired 24,000. So the balance amount that we expect that will come to us in the next year, for which the provision has to be recorded, is actually 16,000. So this is the working, right? Uh, and eventually we recorded warranty expense debit and warranty liability credit. So you see the warranty expense total comes out to be 16 plus the 24 in the previous accounting entries, 40,000, whereas the liability is 16,000 because 24,000 we have already paid. So we have already replaced the parts. So the net liability for as on the balance sheet date is actually 16,000. And then during the next year, if we honor certain liabilities, and if we replace certain parts, then we make the entry according to the amounts applicable. Okay, so again, I would suggest that we don't use the word warranty liability, we use the word warranty provision, right? Because this is a provision.